The canary in the coal mine is Evergrande, and Evergrande is not really what concerns us. But for listeners that don't know, Evergrande is at one point I think it was the most valuable real estate company in the world. It was the second largest property developer in China, and around August, September 2021, they started having liquidity problems, and by the end of last November, they actually started defaulting on debt. And this, in part, was a result of China and the Chinese Communist Party and Xi Jinping in particular cracking down on property developers. So in 2017, 2018, Xi really started pumping the brakes on credit in China, and he didn't want the property market to keep booming. A lot of Chinese companies listened. The property developers didn't. And we can talk about maybe why they didn't and why real estate is so important to China. But the important sort of thing is that after they didn't, the Chinese government basically started telegraphing, hey, we're not just going to bail out these property developers. They have to learn a lesson here that if they're going to engage in irresponsible lending and empty growth calories, that the Chinese government is not always going to be the backstop. And that was a big shock to the market. I think the market was expecting that China was always going to go to the rescue. That's fine. That was part of our bullish thesis. We would expect China to do that because that means we're getting a more productive economy where debt on a balance sheet actually means something, and it's not just something that can be swept under a rug by an asset management company, which is what China used to do in the past. The problem, though, is that in the last, couple weeks, in the last month or so, you've been getting individuals who don't want to pay their mortgages, and you've been getting protests outside of banks because they were sold wealth management products and they want their money back, and they're not getting their money back. And you couple that also with the sharpest decline in Chinese real estate prices since 2014 or 2012. Those were two other moments when Chinese real estate prices started to go down. But you've got some months of data now where not only are the property developers in trouble, it seems like real estate values are also going down. And this is where the importance of Chinese real estate in the Chinese economy is important. I mean, just to throw some stats at the listeners, 65% of private household assets in China, this is 2018 data, but I assume it's similar today. 65% of private household assets in China are in some form of real estate. That's compared to 49% here in the United States. Basically, the way that Chinese people put wealth away is they buy property. 87% of urban households own their homes in China. Another 20% own multiple homes. And I mean, one of the other real stats that kind of blew my mind was that the value of the real estate industry in China tripled basically from like the late 90s just to 2006, and it's been doubling and tripling ever since. That was kind of the problem. And Rob, you were actually the one who said to me that you didn't like this. So tell me, in that mishmash of things that I identified, what was the moment where you stopped and said, we need to look at this a little bit closer?
I think it's helpful to step back and look at the last 10 years in a sort of timeline to answer that question. Mm-hmm. I think it was in 2010 that Jim Chanos famously said that China is on a treadmill to hell. And, that was when the peak of worrying about China was taking place. And people were taking videos of the ghost cities, and these exposés were all hitting the news wires, and there was a lot of concern. And Jim Chanos was right. The problem is that the treadmill can keep going for much longer than people often expect. Mm-hmm. And that was 12 years ago now. That's a lifetime in financial markets. The background to this is that China's economy, I guess, it's difficult to overstate how big this problem is. And part of our sort of sleepiness about this is that we've been living with this for so long, we've just assumed that this is how it is. But when you look at the scale of malinvestment in China, the scale of debt in China, like this isn't some little emerging market pissant country that has a 10-year boom and then things fall apart. China has become so large that it's literally unprecedented, the issue that we're dealing with here. So just to put some numbers around that, 10 years ago, when everyone was worried about Chinese debt getting out of control, the total debt to GDP in China was something like 120%. Since then, it's gone up by more than 100 percentage points. So just to put that in absolute terms, China is technically the second largest economy in the world. We're talking about 25 to $30 trillion of debt, and so that's the scale of the issue. The kind of fundamental problem here is that after 2008, China continued pushing on the gas pedal of its economic model, which is based around investment. Like, everyone thinks about China as this export powerhouse, and they are, but really the economic model is the same as the Soviet Union's model, which was seize savings from households, direct that into investment to catch up with the West, catch up growth, invest in highways, invest in factories, invest in railroads. This is what that model excels at. And for a very long time, that was great for China, because every bridge, every railroad that they would build was very productivity enhancing. The problem was, like, somewhere around the mid 2000s, it stopped being productive to build the next railway, to build the next bridge, to build the next apartment building, because you weren't getting the productivity boost out of those things to justify taking on the debt to build them. And the way that you can see this is when debt to GDP goes up, that means for every dollar of debt you're putting into the economy, you're not generating the GDP to pay it off. So that's the one metric that you can look at to see the inefficiency of the investment that's